Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Paranovis Entertainment, or PAVS, presents, well, it's one of the most volatile paradoxes you'll find in the microcap space today. We're looking at a company that completely changed its business model. It went from nutraceuticals to high-growth AI and social commerce. And in doing that, it reported an almost unbelievable 18,037% year-over-year revenue increase. That's for the interim period ending September 30th, 2025. And yet, here we are. Today is December 18th, 2025, and all of that operational success is just completely overshadowed by a corporate catastrophe. The company had to execute a drastic 1-for-100 reverse stock split just to stay on the NASDAQ. Its equity value had totally collapsed.
And that collapse, that's the real story here, not the headline revenue figure. To really understand the sheer violence of the market's reaction, you have to look at what happened just yesterday, December 17th. The trading volume was extraordinary, and critically, the off-exchange short volume hit over 34 million shares. That is a staggering 43.72% of the day's total trading volume. The market structure itself, when you couple it with the insider behavior, is screaming that something is fundamentally and structurally broken with this company.
Right. And that really brings us to the central question. Does this huge financial turnaround, we're talking $12.4 million in revenue, by shifting from, reishi mushrooms to AI, does that outweigh the structural risks of just extreme dilution and, frankly, governance manipulation? I'm going to argue that PAVS is actually executing a very high-risk but necessary pivot to a relevant sector. And the collapsing price, while it's disastrous, is mainly the result of the aggressive financing methods needed for that kind of rapid growth. And it's been compounded by volatility and, as you said, external market suppression.
See, I look at it a completely different way. My argument is that this collapsing stock price isn't some accident of market volatility. I think it's the predictable, almost engineered outcome of systematic corporate behavior that, to me, looks a lot like a wealth transfer mechanism. The reported revenue, while it looks great on paper, is, I believe, misleading and of exceptionally low quality. It's just there as a temporary justification for ongoing capital extraction.
Okay, so let's start with that operational shift, because that really sets the stage for why the financing decisions were strategically necessary. PAVS used to be happiness biotech, tied to the, let's call it the old economy. Management made a very shrewd, very opportunistic move. They saw the macro trends, AI, short-form video, the whole TikTok economy, and they executed a profound pivot. The name changed to Paranovis, beyond the new. That was a signal of a complete structural break, shedding all those legacy liabilities from the mushroom and supplement business.
The shape-shifting is undeniable, I'll give you that. But the result was basically a corporate shell that was just waiting for a massive asset injection. And that injection, the acquisition of Bumiwuku Inc., that's where we really have to scrutinize the claims of a turnaround.
And the results of that acquisition are, I think, compelling evidence of a real turnaround. For the 6 months ended September 30th, 2025, total revenue jumped from a legacy number of just $68,000 to over $12.4 million. This isn't just, incremental growth, it's a fundamental transformation of scale. And crucially, the company flipped from a net loss of over $400,000 to a reported net profit of $97,708. That stabilization to GAAP profitability, even if it's marginal, is significant proof of concept.
I'm sorry, I just can't buy that the hypergrowth narrative justifies this kind of catastrophic equity destruction. And let me tell you why. That 18,000% revenue jump, it's elusive. It is the classic denominator effect that companies use to grab headlines because you're comparing your current revenue to what was basically a dormant shell company with minimal sales. We have to look at the quality of that new $12.4 million in revenue, and the quality is, frankly, terrible.
Why? Why do you call it terrible?
Because the math just doesn't lie. They got $97,000 in net profit from that. That means their net profit margin is a microscopic 0.78%. And that low margin is absolutely critical. It strongly suggests that Bomi is recognizing revenue on a gross basis, meaning they count the full transaction value of goods sold through the TikTok platform as their own revenue.
Well, that's a common practice in certain e-commerce models.
It is, but the market knows exactly what it means. If they're selling a $100 widget and they're counting the full $100 as revenue, when their actual take-home is maybe $5, the commission, the service fee, which would be the net basis, then what you get is top-line inflation without any bottom-line substance. Institutional investors see that and they immediately apply a massive valuation discount because the only revenue they actually care about is starved. That 0.78% margin confirms that the service BW provides is either easily replicated or it has extremely high operational costs.
I see why you emphasize the margin. I do. But if you look closer at the financials, they reported $2.48 million in gross profit. Now that indicates substantial transactional activity and scale. It proves that the asset they bought is generating genuine flow, and the company is now GAAP profitable. The low net margin? Well, it's a classic symptom of a rapid transition phase where your costs, customer acquisition costs, influencer fees, platform fees, are necessarily front-loaded to get market penetration and establish scale quickly.
Okay, even if we accept the front-loading cost argument for a moment, we have to talk about the physical red flags surrounding this whole operation. The $44 million implied valuation for Bomi, it just stands in stark contrast to its listed headquarters at 747 3rd Avenue and PAVS at 250 Park Avenue. These are prime Midtown Manhattan addresses, yes, but they're often associated with virtual offices, mail forwarding, shared services. A $44 million enterprise that's supposedly focused on high-volume e-commerce and AI, it should have a much more tangible, dedicated operational footprint than what looks like a digital mailbox.
I'll grant you that the physical footprint invites scrutiny, but in the modern digital economy, especially one centered on social media and AI, scale is often decoupled from real estate. But you know, the greater operational risk you haven't fully addressed is external. BW's revenue is entirely dependent on the TikTok ecosystem. That is a massive single point of failure that faces an existential regulatory threat in the U.S. over national security concerns. The market is pricing in the possibility that the entire $22 million acquisition could become worthless overnight. That extreme fragility is exactly why valuations should be low, regardless of the gross profit.
Right. And that fragility, combined with the questionable revenue quality, is precisely why the financing mechanisms they chose are so destructive. Let's pivot to the capital structure. You claim the at-the-market offering, the ATM, was necessary for liquidity to fund the acquisition.
Precisely. To fund that $22.44 million cash transaction, they leveraged a $100 million shelf registration for an ATM offering. Now, for listeners, an ATM offering is basically the company selling new shares directly into the open market over time. It gives them a flexible source of cash. Management needed fresh equity to make that pivot happen fast, and they were willing to use equity to get it. The pop and drop we saw after the December 5th earnings report, that's just market volatility and retail investors exiting, probably exacerbated by some poorly timed sales from the company.
That's a compelling argument based on necessity, sure. But have you considered that the mechanics seem designed not for shareholder returns, but for capital extraction by the issuer? That $100 million shelf for the ATM, that represents a massive potential supply shock. We're talking maybe 2 or 3 times the company's prior market cap. The dilution is so overwhelming that it just crowds out and crushes any natural demand for the stock. And this leads to what traders call a death spiral.
How does that spiral work exactly?
Well, sophisticated traders, they know the ATM is active. They know it's constantly injecting new supply. So they front-run the offering. They short the stock, they drive the price down, which then forces the company to sell even more shares at even lower prices, just to raise the same amount of cash. And this just accelerates the whole downward momentum. The destruction of equity value, 96% over 12 months, is a direct consequence of this supply shock. And then look at today's action. This 1-for-100 reverse split, it's not an isolated event. This is the second split in 3 years, after a 1-for-20 split back in 2022.
I agree. The destruction of the equity value it's catastrophic.
This pattern signals chronic value destruction. The market calls it split fatigue. For your average shareholder, that 1-for-100 split today just means 100 of their shares vanished and reappeared as a single share. And that new higher price share will likely just be diluted again instantly by whatever capacity is left on the ATM. This isn't just financing. It's a destructive, chronic structure.
I acknowledge that the reliance on reverse splits is a profound red flag. It signals a failure to maintain value. But I still believe the stock price collapse is fundamentally a supply problem that's amplified by external market structure, not just an insidious internal mechanism. But before we get to the external factors, we do have to address the governance change that allowed them to do all this.
Exactly. We have to look at governance first, because the intent behind this whole capital structure is made perfectly clear by one very recent move. On November 26, 2025, management executed what I call a stealth dual-class maneuver. They quadrupled the CEO's voting power, increasing the weight of Class B shares from 20 votes to an astonishing 80 votes per share.
An 80-to-1 voting ratio is shocking. I will absolutely give you that. It looks engineered for control. It decouples the interests of management from the public shareholders.
It's more than engineered for control. It's engineered for defense against the very dilution they initiated. This maneuver ensures that even as the public Class A shares are massively diluted by the ATM and they bear all the economic risk, they absorb the price collapse, the CEO retains absolute ironclad control. It completely decouples economic risk from corporate control. The public shareholders they're fundamentally disenfranchised. The whole thing is transformed into a pure funding vehicle for the controlling party.
I'm still not convinced that even this egregious governance issue is the primary driver of the rapid collapse we saw yesterday. That's a long-term problem. The immediate price collapse is fundamentally a supply problem, and it's amplified by external market mechanics that we can see directly in the microstructure data you brought up.
So let's go back to that data. The off-exchange short volume was 43.72% of total trading on December 17th. Nearly half of all trades never even hit the lit NASDAQ exchange. Why does that matter if the dilution is the main problem?
It matters because price discovery is being suppressed. When retail buy orders are routed through wholesalers, they're often called internalizers to dark pools. They just get matched against inventory or short orders off exchange. Those trades don't interact with the public bid-ask spread. So what this does is it dampens any natural upward pressure or momentum the stock might otherwise have. It prevents the price from reflecting the operational success, however low margin that success might be.
So you're saying the market structure is basically turbocharging the downward spiral.
Internalization mechanism is preventing any organic demand from pushing the price higher, and that's what trapped it at sub-penny levels until the reverse split was absolutely required. I think the focus should be on this external market mechanism as the immediate cause of the listing failure.
I agree that the market structure facilitated the price destruction, but we can't ignore the catalyst. The internalization only has that power because the ATM created the massive constant supply shock. To begin with, the governance paved the way for that supply shock. It secured control while it happened, and the market structure then maximized the damage to public shareholders. That 80-to-1 voting ratio was the defensive shield for the CEO against the very dilution she initiated with the ATM. You can't separate those three elements.
My perspective remains that the $2.48 million in gross profit, the move to GAAP profitability, and the pivot to a viable high-growth sector are strong signals of management's strategic ability. The structural issues, the dilution, the splits, are financing side effects of aggressive growth, and they're complicated by sophisticated external market pressures like that extreme off-exchange trading volume. The company achieved a critical corporate shapeshift, and that transformation has to be weighted heavily.
I stand by the thesis that the evidence points overwhelmingly to a company prioritizing control and capital extraction over shareholder value. The structural red flags, the 80-to-1 voting power, the dependence on these capital-consuming offerings, the low revenue quality reflected in that 0.78% net margin, and the repeated reliance on reverse splits. It all suggests this vehicle is engineered for high-velocity capital destruction, merely masquerading as a growth stock.
The PAVS case study it perfectly illustrates the tension between these headline-grabbing growth metrics like an 18,000% revenue spike and the absolute necessity of doing forensic due diligence on corporate governance and capital structure. They did deliver explosive top-line revenue that stabilized the business, but the volatility is a function of its chosen funding path and the external market dynamics that are preventing price discovery.
Absolutely. The material provides more than enough evidence for a listener to weigh whether the hypergrowth narrative or the destructive structural dilution mechanics, capped off by today's 1-for-100 reverse splits, will ultimately define PAVS's future. It's clear there's much more to explore in understanding how these microcap companies can engineer financial narratives while simultaneously prioritizing and securing absolute insider control.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.